Today's episode of Market Talk is brought to you by GrowMark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now to take a look at the week of trade that we saw wrapped up on Friday. Plenty of news items to unpack and discuss and look at how this market has reacted here the past week. Joining us now is our good friend Ted Seifried with Zaner Ag Hedge. Ted, good to have you on the show. Thanks for making the time today. I know you're traveling and in Omaha here for some conferences today.
Yeah, good old sunny Omaha. It's been a lot of fun. Really big conference, good turnout. It's great to see people coming out and doing things. You know, it's nice. It's nice to be on the road sometimes.
Definitely. Well, glad you were able to make some time to be on the show with us here today. And as I said, plenty of news items to unpack. Friday, fairly quiet trade. I know we're looking at South America weather forecasts with rain chances in Argentina. We had a pretty solid weekly export sales report early on that felt like it gave us some news to talk about. China's headed into their Lunar New Year holiday. So, I mean, you know, wherever you want to start here, Ted, but there's quite a few things to unpack in this grain trade as we wrapped up the week.
Yeah, and as you said, Jesse, export sales were pretty good. And the good news is that it was corn that beat expectations. Soybeans were within expectations and okay, but it's nice to finally see a halfway decent corn number come out. That was really impressive. And also soybean meal. So, you know, feedstocks, that's great. Aside from that, you know, this week has kind of felt like a bit of a tug of war. Wheat finding a little bit of a bid there Friday, but corn has wanted to be relatively strong compared to the soybeans, which feel like they really want to come down. And I think that soybean weakness is tied into the fact that South American weather, Argentinian weather looks a bit better. We know that this Brazilian crop is coming online, and it's you know, early harvest results we're hearing are maybe a little bit better than expected. But then on the corn side of things, we still have to get through that second season corn crop before we can say the supply situation, the tighter supply situation, we're out of the woods on that. But I will say, if we get through that second season corn in Brazil and they have the crop as advertised, it's going to be real tough to justify the prices that we're at. While our domestic balance sheet is fairly tight at a 1.25 billion bushel carryover, it's not really tight. And the global carryover isn't really tight. And we are seeing lots of signs of demand destruction occurring in corn. That was really highlighted on the USDA report that we saw last week. Year over year, you look at feed demand down 443 million bushels. You look at our export expectations at the lowest level that we've seen since 2015, 2016. You know, they say it, I'm not a huge fan of cliches, but they say that high prices are the cure for high prices. And you got to feel like that's kind of happening in corn. It not quite happening yet in soybeans, even though the crush has been, you know, a little bit lower than expectations. You feel that demand destruction happening in corn. And so now the question is, what happens if we start to turn the supply spigot on? That second season Brazil corn crop followed up by, you know, what if we plant 88, 89 million acres of corn here? And what if we have a good growing season? And we're not far away, Jesse, from the conversation again that we were having, you know, 2014, 15, 16, 17, 18 of we're oversupplying the market. Global supply, global production is outpacing the growth in global demand. And the multiple years of high prices is going to put a big damper on that demand. At some point, we'll have to go and buy that back again. So that's the concern going forward. There can be things to keep markets higher. Again, production problems. Second season Brazil corn crop, that's very much the focus going forward. But if that second season corn crop in Brazil turns out good, it's going to be tough because, again, we are seeing the demand kind of fall off a little bit.
Well, Ted, I posed this question to a couple folks this week. I'll pose it to you as well. As you look at old crop versus new crop, now that we've got the USDA reports past us and some of the different news items this week, are you more concerned about downside potential in old crop, new crop, or both at this point, Ted?
It's a really good question, Jesse. I'm going to say both because that's me personally. But if you look at the markets and you look at what's happening from a spread perspective, there's a lot more concern about further out in time, and even if you go like into July, but that December contract is really been under a lot of pressure. And if you look at a March corn contract versus a December corn contract, they tell two very different stories. And what it's saying is that the market's still worried about tightness up front, i.e. until we get to that Brazilian second season crop. Right now, we are the corn game in the world. So there is still that tightness reflecting the current USDA's old crop balance sheet. But you go further out in time and the market feels a lot more comfortable that those stocks will be there. And therefore, you have prices that have been under pressure. And again, that December corn chart it's been in a very solid downtrend and has not broken out of it, unlike the March has. With that report, we broke that downtrend line. We're trying to hold above it, but the December didn't do that. And so market's saying that further on down the line, we're seeing weakness because, again, we are expecting that, demand's already fallen off to some extent. Now we just need to see one or two good crops between South America and us. And all of a sudden, the global balance sheet looks much different.
So if I'm a producer sitting in the Midwest getting ready for spring planting, I'm booking inputs, or I'm looking still at old crop and have some old crop sitting in the bin, not sure if I should move it or not. We think about some of this downside potentials there. Seems to me an easy answer to protect some of that risk. Do something better than nothing at this juncture. Yeah. Can you talk about that a little bit?
Absolutely, Jeff. This is not the time to be complacent. The market's kind of rewarded guys for being complacent for the last couple of years, right? Not marketing, not selling, and even just selling off the combine. That's gone well. But this is not the time to be doing that because, again, we are seeing that demand destruction. It's a great time to be selling cash. If you want re-ownership, there's call option strategies. Right now I'm putting on for December new crop, I'm putting on the 640, 720 call spread for around 18 cents, 80-cent upside potential on a $1.20 rally. It's a great way to re-own those bushels and move to the upside. But if you're selling cash, you don't have any risk on those bushels anymore. The risk that you have is the 18 cents you paid for the call spread, and that's your opportunity cost, right? I get it. At this time of year, even before we plant, we're not willing to go and sell 80% of our crop. We don't know if it's going to be there. So I understand that. You can still buy puts, but puts have gotten fairly expensive. You look at a 550 put for December corn, you're paying 27 cents roughly, which makes your break even 523. And you look at, near $6 December corn, 523 doesn't feel all warm and fuzzy. In fact, that might actually be below some people's break evens. So I think we want to be really aggressive on export, really aggressive on making our sales for new crop. I've been pushing guys to get 40, 50, even 60%, whatever we're comfortable with. Let's go. Because again, we can come back in and do these re-ownership strategies for relatively cheap that have all the time we need. And if the market goes higher, then great, we have that in place. But the big concern is, I'm not worried about the market rallying $1. I'm worried about the market breaking $2.50. That's something that we need to protect, especially with paying these high priced inputs. This is the most risk that we've ever had in a corn crop in any of our careers. So we got to do something to protect that. We got to make sure that we're not having a very uncomfortable conversation with the bank at the end of the year.
Well, and it just feels like that's kind of the way that, marketing in agriculture has gone now the last couple of years. As more money comes into ag and we see prices of inputs go up, prices of commodities go up, there's just more money on the table. And so that old methodology of set it in the bin and forget it, the romp appeal method, doesn't necessarily work nowadays throughout agriculture, Ted.
No, Jesse, bins are a great thing to have, and in some years they are the savior, right? This is not one of those times. It will be again in a matter of year or two, maybe, but right now is not the time to store and ignore. Now is the time to be aggressive and proactive on protecting the prices that we have because of the amount of money that you're spending on this crop.
Yeah, very, very true. Very, very true. Ted Seifried, Zaner Ag Hedge, our guest here today on the show. Ted, crude oil. I know we like to talk crude oil, you and I. Last time we talked, we're pretty much the same price level last time we talked. A little bit above 80 on the day on Friday to wrap up the week, but yet we just don't want to seem to break out of this range. What's your latest thoughts with what's going on in this crude oil market?
It's not the time of year, Jesse, where we would really see a significant breakout in crude oil without a really cold weather event, right? And heating oil leading the way. You talk about gasoline demand, peak driving season. Well, that comes in the summer. But yeah, it does really feel like crude oil's trying to carve out a longer term base here of really any of the commodities. I'm not bullish commodities as a whole. You hear Goldman Sachs saying that could be the hottest sector, and you wonder if that's the death cross there. But of any of them, really crude oil, because again, we've completely depleted our strategic oil reserve. We do need to refill that. The Biden administration wants to do it in the 60s. Markets don't like to give people what they want, so we might have to do that higher. And again, yeah, I mean, at some point an event will happen where we do either a heating oil event, i.e. cold weather, or we just get to the spring and summer peak driving season. I look at July crude oil, like you said, trading 81 and a quarter. I think at some point we're going to go try that $100 mark again. So I do think there's upside potential. And I think what we're seeing, like you said, same prices we talked 2 weeks ago. This is an overall broader basing pattern, it feels like. There's a number of things, Jesse, that can throw a wrench into that mix. Global, recession, pandemic again, some sort of black swan event. But short of something like that, I do think that crude oil is really trying to carve out a base here.
Definitely. Well, and thinking about the broader economic picture at crude, in the stock markets, et cetera. China, I know we continue to watch what goes on in China and the COVID issues that they've been having, the talk of their economy rebounding. I know their GDP was less than expected here, come out a couple weeks ago, but thinking about their Lunar New Year holiday right now, we'll probably see some more COVID expansion with that. I just wonder what the short-term outlook could be for China and what that could or couldn't do to the broader commodity sector here the next couple of weeks, Ted.
Yeah, no, I mean, that's a great point, Jesse. And that's something that's been kind of goosing the markets this week. I mean, you've seen, stocks under a fair amount of pressure. But, we've been talking about a slowdown in China and Chinese COVID for a long time. It's not a shock. It's not, coming out of the blue. And a lot of this has been priced into the markets at this point. So, the question is, what if we get 3 or 4 weeks down the line and there wasn't this major slowdown in COVID event and they are, let's say, spending more money doing things on this lunar holiday? I think all the negativity, we factored in a lot of negativity to these markets. And that doesn't mean that we can't have more negativity, but the current negativity and everything you're talking about are things that we've been talking about. And that, I think, has been priced into the markets for the most part.
Well, and thinking about China, hog prices have been wild in China here lately. Let's shift over to livestock. We've seen volatile hog prices here in the U.S. A fairly decent day Friday, wrapping up the week. But as we take a look at that hog sector, what stands out to you with what's going on right now in lean hogs?
Yeah, hogs needed a decent day. We were very, very oversold after a precipitous fall off, right? China, we know that their hog herd is up dramatically, and they have their government asking hog producers to slow that down, take it down a notch, which over time might mean good things for our exports. But we know they're oversupplied right now. So we don't have huge expectations or aspirations for our exports to China. We know Mexico's our biggest partner, so maybe Mexico, but this all started, go back to that massive cancellation that we saw, and we've really not been able to pick ourselves up on since then, right? I mean, we've not really been able to find that export demand, and from a domestic standpoint, we had that big increase in weights when we had that major storm in the middle of December that pushed marketings back. And we've really not been able to work through that, which is a bad indication of domestic demand as well. So we've got a bit of a demand problem in pork or in hogs. And while I do think we're oversold, and while I do think we're due for a bounce, and I think we've maybe overshot the market to the downside, I just don't have a really good reason for hogs to go back up and make new highs anytime in the near future, right? That may come down further the line if the Chinese producers do listen to what the government's asking, and Chinese government has a tendency to get what they ask for. And then we see that production swing to the other side, and our exports all of a sudden start to pick up. Maybe that's something for further on down the road. But at least for right now, I'm hoping that we've just defined the bottom end of a trading range that we might be in, and maybe we can establish some sideways trading going forward here, Jesse.
Well, in the relationship between hogs and cattle, too, that spread between hogs and cattle has been very interesting to watch. It's been widening out. We're talking ahead of a cattle on feed report out on Friday, which sounds like it's going to be another bullish cattle on feed report, yet the cattle market, it doesn't seem to want to break out to the upside or to the downside. It's just kind of staying range bound here. I wonder your thoughts, that relationship between hogs and cattle. Are hogs being an anchor on this cattle market right now, despite all the bullish storylines that are out there in cattle, Ted?
Well, they're certainly not helping, right? And that like you said, that relationship or that spread between cattle and hogs is abnormally wide, which should mean that there will be some choices made both by the domestic and by the global end users to maybe push towards pork. So that is something. But also, you have concern about beef demand just based on, like you said, we're worried about the economy, we're worried about the stock market, we're worried about global economy and what that means for demand. Are people going to be willing to spend on what's considered luxury item meat, things like that? So that's kind of kept a lid on the cattle market. Now we also have a bit of a floor because we've got this widely advertised slowdown in production for the next 3 quarters. Just don't have the animals out there, right? So I don't think there's a whole lot of downside potential unless you really have again, like we talked about earlier with crude oil, if you have that global recession, that's big, fear. If you get fear, that changes everything. But for right now, because of that drop in supply, I don't see a whole lot of downside. But because of our concerns over demand, it's really keeping the upside limited too. So maybe that just means that, once again, sideways trade for now.
Could be very true. Something to keep an eye on. Ted, before we run out of time and let you go here on the show today, any final thoughts? We touched on quite a few things. I know there's just a lot of different news headlines swirling around these markets here as we work through the month of January. So I'll leave it to you. Final thoughts, anything you want to share with us?
Yeah, we really harped on, corn and managing risk there. I think that's extremely important. And while soybeans, you're not seeing the same amount of demand destruction there. You look at the prices that we're at. You look at the potential for, I hate to say, but I mean, at some point we're going to see a big drop, right? So I think you got to be pretty aggressive on your marketing there too. I'm going to say it again. Now is not the time to be complacent. This is the most risk of any crop that we've ever had. And I say that specifically on corn because of the cost of inputs, but you got a lot of risk in soybeans too. And so I think you really need to be looking at ways and strategies to protect that downside and, help you sleep at night. That's very important.
That is very important. Well, folks want a little advice to help them sleep at night when it comes to their marketing. I know they can reach out to you and the team there at Zaner. What's the best way to get a hold of you, Ted?
Yeah, you can reach me directly at 312-277-0113. Aside from that, you can find us on the web at www.zaner.com. And you can find me on Twitter. I'm at the Ted Spread.
Very easy to find him on Twitter and reach out to him as well. Again, Zaner.com is a great place to start as well. Ted Seifried, Zaner Ag Hedge, thanks for joining us, sir. Have a great one, and we'll talk to you again soon.
Thanks, Jesse. Always a pleasure.
And that's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.